Good afternoon, everyone. I'm Tim Richards, Technical Services Manager of the Managing General Agents Association. And on behalf of the MGAA, I'd like to welcome you to our briefing this afternoon. This is being delivered by Bridgehaven with the hybrid fronting insurer delivering capacity to MGAs. I'd just like to run through a couple of housekeeping points. Please can you ensure your microphone and camera are turned off unless contributing. If you'd like to ask a question, feel free to use the chat button at the bottom of your screen. Time allowing, these will be asked and answered at the end of the event. And if we run out of time, questions will be answered post-event. This presentation is accredited for CPD hours if relevant to your ongoing professional development programme. The briefing is being recorded and a link to the recording will be issued post-event together with the slides and our feedback survey. Please take the time to complete our survey. It takes no longer than 2 minutes and allows us to deliver the best possible future events to our members. So as a recap, today's briefing is the hybrid fronting insurer delivering capacity to MGAs delivered by Bridgehaven. So let me introduce you to our presenter, Paul Jewell. Paul is Chief Executive Officer of Bridgehaven Specialty Insurance with overall responsibility for all operations. Prior to joining Bridgehaven, Paul was CEO at Best Doctors Insurance and Shorestone Reinsurance. He started his insurance career back in 1988 as a commercial lines underwriter at a global insurer before moving to AIG, where he went on to become global CUO of the commercial SME business, including US and Canada. Paul joined Towergate Insurance, now Ardonna, as Chief Underwriting Officer before his move to Best Doctors Insurance. Having been appointed as Bridgehaven CEO in January 2023, Paul has devoted his time to setting up the business and leading the team on an ambitious strategic growth journey. So without further ado, let me pass across to Paul to begin the briefing. So Paul, over to you.
Tim, thank you very much. Thank you everybody for joining this afternoon. It's great that you're able to spend some time. And thanks, Tim, for inviting me, part of the MGAA, to give this briefing session. So you've currently gone through a little bit of my bio. 35 years in the industry, and I've had a very varied career. And one thing I would say is learning never stops. An old adage I hear from many people, but it's always interesting. I'm still learning lots, and hopefully this briefing will give you a bit of insight into fronting, hybrid fronting insurers, and so on. So today's topic that I'd like to go through, and looking through the learning objectives, is to talk through the hybrid fronting model, fronting generally, and give you an appreciation of how the model works, what capacity is available, how alternative types of capacity work, some of the benefits that you may get, and then we'll summarize and do a Q&A at the end. Approximate running time somewhere between 30 and 40 minutes. No jokes to be included at this stage, but maybe at the end when we finish. So let me start off with, what are the learning objectives for you today? Well, the learning objectives that I have are to explain what a fronting insurer is. You may have heard of fronting insurers, you may understand or not understand what maybe the fronting model contains. And I'll explain in a little bit of detail with some examples of what actually I think it is. I'll then talk about how fronting insurers use different types of capacity and how a hybrid fronting model works, but then explain what are different types of capacity, what are the ability for fronting and a hybrid fronting model, where can we get capacity and alternative solutions from. And then, as I mentioned earlier, we'll summarise some of the benefits for MGAs and third-party underwriting specialists and captives and so on that may well use this type of solution. I think it's fair to say that the fronting model is fairly new to the UK, but it's been in the US for quite some time. The US, probably about 7-8 years ago, had 4 or so fronting carriers, and I'll explain what a fronter is in a second. And today it has well over 25. The UK itself, and even into Europe, is relatively new. So we have a way to develop as an industry sector for fronting and hybrid fronting. So you'll see more of this develop over time, and hopefully through these learning objectives, and as I explain a little bit more today, that you'll understand as things evolve where and how to access sort of fronting opportunities. So let me start off with what is a fronting insurer? Well, a fronting insurer is actually an insurance company. It's no different to a traditional insurance company. It is regulated in its own right. It's approved by regulators. It may be for all classes of business or specific classes of business. But acting as an insurance company, it may do transactional business, so individual customers' policies, or it may do a broader range of business that could well include captives or MGAs. And the examples that I'd probably give you of what does a fronting insurer look like? Well, actually, fronting insurance has been existed in the marketplace for a long, long time. If you take multinational companies, we could take anyone. Let's take Marks and Spencer's as an example. They've traded internationally, so they may require an insurance solution that is more global. Pepsi Cola. There are other cola brands available. There are many different organizations that what they'll need is they'll need to be compliant in the local territory. Here in the UK, the US as an example, Australia, Canada, many jurisdictions require local policies to be issued. As you know, in the UK, we have employers' liability and motor liability, which are both compulsory classes of insurance. So if you have somebody like a Pepsi Cola that has employees in the UK, they may have a master reinsurance or insurance structure, but they need to issue a local policy in that country. So the example I'm giving you is the UK. So issuing a local policy in the UK, they need to work with a fronting insurer if they don't have as part of their structure an insurance company that's got licenses in all jurisdictions and all countries. So I was in AIG, as Tim mentioned, as part of my career. Multinationals were a big element of our business, multinational companies who required us to have relationships with insurance companies, fronters all around the world. We had some of our own licenses and we needed other companies who acted as a fronter. They would normally have the conduct and compliance risk, but we would cede back, we would reinsure all of the underwriting risk back to the master policy where if you like, where it was administered and organized. These are mostly, as I was talking about, cross-border types of programs, but the fronting carrier was acting on behalf of the insurance company. So this example I was using was AIG, just to issue a local policy. So if it was for Pepsi Cola, it was to get around the regulatory risk to ensure they were compliant, but it was just focused on issuing a local policy, collecting premium, collecting taxes, but then reinsuring back to the master program. That's traditionally what fronting insurers have done. They've acted on behalf of captives. Captives also, because of their nature, usually don't have regulatory licenses in the territory, so they would also be acting as a fronting vehicle. So fronters, very simply put, are insurance companies, but traditionally don't take care of anything other than the conduct and consumer exposure, the regulatory exposure, premium collection, and so on. Usually, it's been more on transactional individual businesses, policies for particular customers, could be part of multinationals. Okay, so what is different with hybrid fronting? Well, hybrid fronting, the connotation here is the retention of risk and the focus of retention of risk of taking care of the capital exposure. Hybrid fronters, and what is hybrid fronting is retention of risk, can be in retaining some of the underwriting risk exposure. It could be all of the underwriting risk, so retaining the risk 100%, or using reinsurance. But similar to fronting, they're insurance companies. They retain 100% of the compliance risk and conduct risk, and they will look usually for distribution, not solely through just MGAs, but maybe working with captives, working with other facultative solutions, could be on a risk-by-risk basis. So hybrid fronters may well be looking at a broader range of distribution, but are insurance companies and act like any other insurance company that you would come across in the UK market that retains risk. The difference for the models will depend on the hybrid fronter. So as an example for Bridgehaven, where I work, this is a very simple explanation. For yourselves as members of the MGAA, the majority of the members as MGAs will not be retaining risk yourselves, although you may have captives, and I'll come back to that. But MGAs will be soliciting capacity from an insurance company. You may have capacity from Lloyd's or from traditional composite markets like an Aviva or an RSA and so on. There are many insurance companies that provide protection. From a hybrid fronter, we're an insurance company that retains all the risk, regulatory focus, the same as any other insurance company, but it's the solution of the capital of where we both use traditional and non-traditional capital to ensure that our solution is better aligned to MGAs. And I'll come back to how a hybrid front may use this type of model to bring alternative capital to the market. So as a hybrid front, the main difference between fronting is the retention of the underwriting risk, profitability, and managing the capital structure behind the insurance company. So if I move on to why would MGAs therefore want to use this alternative type of capacity? Well, in talking to quite a few of you over the last sort of 9 months since Bridgehaven's been formed, I get to hear there's different reasons why MGAs need alternative capacity or looking maybe for this hybrid fronting solution. Often you could be in a situation where you need to replace capacity so that there are insurer changes, appetite changes. And I've heard, over the last few years, insurers tend to change their mind. They may have direct-to-consumer models, business-to-business models. They may have alternative types of business models, and it may not fit with what they're trying to do at that time. So often you'll be in a situation where you've got to replace capacity because it's either been lost, no fault of your own, but maybe a change of appetite or the insurer wants to non-renew. Capacity may be needed for new products, wanting to grow. Again, I've heard from a number of members that sometimes there is a challenge with limitation of some capacity providers on writing too much business. So the MGA space, as I see it, is a very fast growing sector within the insurance industry, both distribution, product innovation, underwriting capability, ease of doing business, agility in the market. And I think that from an opportunity here for providing new products and growth, I think that's also probably high on your agenda. It's also sometimes I hear that there's challenges with clash or distribution conflict. There are certain maybe insurers that can write certain products but are concerned that they're already got too much in a certain product area, or they're unable to provide coverage because it already clashes with an alternative distribution that they support. Or you may be up against certain branch structures if they're doing direct-to-consumer or direct-to-business distribution themselves. Also, there's access to a broader appetite. I hear sometimes from MGA partners that actually they know of or have relationships with reinsurers or alternative solutions, and how do they bring that to market to give them a competitive edge, whether that be a broader appetite or also a lower cost of capital. Reinsurance traditionally and the hybrid fronting models tend to have a lower cost base, which can, depending on the underwriting performance of the originating business, provide advantages to all, both MGAs, insurer and reinsurers. So there's various reasons why MGAs may need capacity and where a fronting insurer may or may not be able to help with those circumstances. So now if I look at, okay, well, that's fine talking about the MGAs, yourselves as members and what sort of challenges you face, and there's probably a lot more than that. But what about reinsurance or capital provision? How does that work? So if I look at capital, there's I'm going to break it down into these four broad buckets. Traditional capacity can be provided either through traditional insurance companies, we mentioned Lloyd's, there's other insurance vehicles. But for a hybrid front where I was mentioning attaching to reinsurance, traditional reinsurance for me tends to be, let's call it rated and brand name reinsurers that you may well have heard of. There are some very large German entities, the Munich Re's, there's Zurich Swiss Re, and so these are entities you've probably heard of. And there are lots of rated reinsurers, the majority of which Europe, Bermuda, USA, and broader afield. There is a whole world of capability that can be attached to or attracted to the UK market with good quality portfolios, profitable books of business with well-run MGAs. And they are very interested in coming in and supporting business here locally. But there are alternative solutions of capital. Captives, there may be some of you that have aspirations to retain your own risk, that you may want to set up your own captive cells. Or there may be businesses that are already through captive solutions, and the captive solutions may also require a fronting or a hybrid fronting capability. And captives own self-retention vehicles. Maybe it's relatively new here, it's much more common in the US, but I have seen more and more of the larger MGAs talking about that and retention of risk and alignment of interest between the MGA, insurer and reinsurer, and retaining more of the profitability is something that I see will have more popularity over the coming years. There are other types of capacity that is available to be brought into this solution. So I use funds as the broad bucket. Funds tend to be other types of investors. Other types of investors could well be pension funds. I have seen pension funds deploying capacity through different vehicles, and sometimes they will set up maybe captives. So the funders or the pension funds may set up a captive vehicle, but then they need a fronting solution to attract or to attach to the distribution point. And that way of aligning with MGAs is also an attraction for a lot of the alternative types of funders, because they don't get access to that business in the traditional sense. They're not traditional insurance companies. And that also sort of links into bonds. A number of you may have talked about or heard of alternative capital like ILSs, insurance-linked securities, and there are other types of solutions that require deployment, and using a fronting hybrid fronter is another way that these types of capital solutions would like to be brought into, and I use the UK market, Europe, globally, and there is alternative capital available to be deployed. Depends on the original products, the scale, the underwriting performance of the MGA, but this is where, if you like, the hybrid fronting models are able to attach to these four alternative types of capital solutions, rather than maybe a traditional process, which is using one insurance company or having a binder or delegated authority from a traditional insurance model. These are very solution-based and very bespoke, depending on the product, the MGA, and the solution we're trying to provide. Hence the reason it's a very flexible model. Building on from that, let me talk a little bit about some of the benefits that there are for you as MGA members, and this is probably what you would be looking for a broad selection of partners anyway, whether that be a hybrid front or any other type of capacity provider. MGAs that talk to me are looking for capacity that goes beyond an annual planning cycle, ideally 3 to 5 years, and having that alignment with the hybrid front model can certainly work. You need to partner with those sorts of hybrid fronters that are okay with full delegation of authority, and we use a trust and verify approach. Not every hybrid fronter will be exactly the same. I can only quote here for Bridgehaven, but the majority of what I've seen, if I use the US as an example, are in a very similar space. You'll also want to take advantage of, higher profit shares. There is a lower cost model, and there's an opportunity to share in the upside. That's certainly something that, if I was to give you an example, composite insurers will run expense ratios 18 to 22%. Cost models in the hybrid front world are probably at maturity somewhere around the 4 to 5% range. So there is an opportunity there to have, with those quality of profitable books, to look at sharing, as I say, more of the upside. I think there's also alignment from a capacity and transparency. One of the things that, again, I know may well frustrate you, when I was running an MGA, what used to frustrate me sometimes was the lack of transparency around our book of business. So your book of business that you run, what the majority of the performance looks like. But when the insurance company then starts doing the reserving approach, so they put it all into their broad buckets of portfolios. It could be the property portfolio, the motor portfolio. They will then look at doing their reserving approach, and often you'll then find your results get batched up with everybody else. And there's lack of transparency sometimes. And I think here, what hybrid fronting should be doing, and we do, is to provide better transparency of the underwriting result, of the reserving approach, but also making sure that there's that alignment of interest. And I think that that's, again, one of the attractions here, that from an MGA perspective, you should be able to get from a hybrid front, better, greater transparency of your results, the performance, how we work together, how we collaborate, how we help you grow. I think that is some of the ancillary benefits that should come from this model, because it's designed and bespoke specifically for each MGA. Speed of decision making I've already mentioned, but the partnership element of this is also important, and I'm sure you all value that from all of the capacity providers you have. Things change constantly. We went through a process of learning through COVID. We have constant challenges with some of the climatic changes. We're going through at the moment quite a lot of focus on ESG, on renewables, on different sectors developing. And that is the best way for us to work through those challenges is together. And I think that that's where this type of approach will provide additional benefits. I often get asked, what are some of the challenges? Well, some of the challenges, I suppose, I would reflect back on any business model really, is going to be the underlying portfolio. The underlying portfolio, is it profitable? Does it need correction? Is it a portfolio that would be of attraction to the insurance company and the reinsurers? If you are in a distressed state, I think it's then the credibility of that plan and the underwriting action that's being taken. Can we take everybody on that journey? So I don't want to give you the impression that the hybrid fronting model is perfect for every solution. It will be very similar to what you face on a day-to-day basis with any capacity challenge you have. But where there are certainly elements of opportunity, where you've got, as I mentioned, the rationale for changing capacity or looking at alternatives, growth, product. There's been a change of appetite from a previous insurer, access to alternative types of solutions. That's certainly where this would come through. So I've covered here a number of both benefits and a little bit of the schematic around the model. What I'd just like to dwell on is I'm going to go through, just again high level, the learning objectives that we've just covered, and talk you through just one or two additional points that weren't covered in this presentation. So in summary, at the beginning, I was explaining, do we know what a fronting insurer is? Well, a fronting insurer is an insurance company. What it does is it tends to front on behalf of another insurance company that is taking care of, or is more important for them, on the underwriting risk. They are usually being a solution just to solve the regulatory policy issuance in that particular jurisdiction. And that tends to be a connotation that tends to be used more globally of fronting arrangements. And as I used a couple of examples, hybrid multinationals, customers multinationals, or where there's a local solution required, tends to be where you find this more often. I mentioned about hybrid fronting. So why was it different? The hybrid fronting was different because I explained that this was to do with retention of risk. So hybrid fronting is there is retention of risk, underwriting on behalf of the insurance company, the hybrid fronter, and the capital providers being the reinsurers. And that provides alignment of interest. And the capital providers, I mentioned 4 different main types. Traditional types of reinsurance, so the rated reinsurers, you may have heard of S&P rating, AM Best rating, the more traditional household names that you would have come across. I mentioned also about captives. Those tend to be self-insured retention vehicles, captive cells. There are particular solutions that are required for those. And then I mentioned 2 other types of capital around funders, which tend to be the investors, that could be pension funds. I also mentioned around bondholders, but alternative types of capital like ILS, insurance-linked securities. And I'm sure that that subject in itself is probably a subject matter for another training session that we could do in the future. So outlining those alternative capacity, what I wanted to describe and explain is that hybrid fronting is able to access all of that type of capacity. There are different ways we do it. We can either do it directly. Sometimes it's in direct combination with the MGA and professional intermediaries, reinsurance brokers. Sometimes it will be brought directly to us where the solution or the partnership already exists. So sometimes a ILS or a particular type of funder may already have a deployment that they want to make across a broad range of portfolio. So therefore, Bridgehaven or hybrid fronters can provide sometimes a broad range of portfolio that they may want to attract to. I then went through, as part of that, why would there be what are the benefits to the hybrid fronting model, but more importantly, what would you be looking for through any capacity solution, to be honest? And just to reflect, I'll go back a slide. Those would probably be things that you would be wanting to have from any capacity arrangement. So to some extent, I'm not describing anything that you've not really come across. Insurance exists, insurance companies exist, reinsurance exists, MGAs, you've been in existence the majority for a long period of time doing great work. So this is changing the combination so that it's directed to support you as a community group. Hence the reason Bridgehaven in particular, although a lot of this applies to any hybrid fronter, for Bridgehaven's perspective, that's one of the key reasons why we support this community group and the MGAA. So to finalize, if you like, the main conversation, and we'll turn it over to some Q&A in a second. I've gone through what a hybrid front is, the different types of models. I've talked to you about the alternative types of capacity that might be available, those 4 different types, and hopefully you can articulate those. And I've also talked through some of the benefits of the hybrid fronting model. What I'd like to maybe conclude on as we go into some Q&A is maybe just to reflect that hybrid fronting is relatively new. It's relatively new in the UK, and I'll just mention Bridgehaven's story. Is when we were authorised last July, 4th of July as it happens, when we were authorised last year, we were told by the regulator we were the first hybrid front to be authorised in the UK with this exact model. There are other companies that may provide something similar, but being regulated as a standalone entity in the UK, we were the first one. And subsequent to that, there have been a couple of other organisations that have recently announced that they also are going to come into the UK market. And I see that as validation of one of our business model, but also support for you and to provide, MGAs, alternative types of options for the future, which together I see that that's going to be a great success. And the more hybrid fronts and fronting models that come in, believe it or not, is I actually think of more benefit to us as we look to disrupt the more traditional types of approaches that maybe you've got in the market. So with that as my conclusion, I'd probably like to hand it over to some Q&A, noting that we might well have some to follow through. So Tim, is there anything in the chat that you'd like to go through that I could pick off?
I do have some questions, Paul. And anyone on the call, if you'd like to pose a question to Paul, then please type those questions in now. We do have plenty of time for Q&A. So anything on your mind, just type it in, and I'll make sure that's put to Paul. So, and we do have one that's just literally the second come in. So, in your view, what is the biggest risk of the hybrid fronting model?
That's a good question. With any insurance company, there are various risks. I think the risk is twofold. The first is the selection or partnering with the MGAs. So with the members that are here listening, I think always for any hybrid fronter, it's making sure that the underwriting risk, the profitability, that we're working together to ensure the MGA wins, the insurance company wins, the hybrid fronter wins, but also for us, it's the reinsurance. So the second part of it is the reinsurance angle. So why do I say the reinsurance is, as with any situation that we face today, if there is a loss-making portfolio, we understand that there can be reasons why, but continually losing money, the hybrid fronting solution would lose its reinsurance capacity over time. Now, there can be solutions, it could be, we might be able to change it, but the biggest risk for us is making sure that the MGA is underwriting or understands its underwriting for profitability, doing its best to do that, whilst balancing out the need for growth to earn its own commission, but also making sure there's sustainability and longevity to the business model, which you can only get through underwriting profitability. That's exactly the same for us as a hybrid front. If we're reliant on reinsurance, and let's say we're reliant to 80 to 90% is the reinsurance that we require to purchase. If again is unsustainable, that there's consistent losses, that would be a problem for us in our model. I think so those are the two sides. So it's underwriting profitability related to the MGA, which has a high correlation with the reinsurance. I think the other risk that we face, and this is probably we face together, is we are in a heavily regulated environment, and rules and regulations constantly ebb and flow. We need to adapt to those. Some of them are easier to adapt to than others. And I think here for me, it's as an organization, we have to be careful that we're not duplicating effort. So there are a lot of conduct, consumer duty requirements. There are a lot of requirements on MGA members, being majority either FCA regulated or ARs. And for that point is if as an insurance company we're duplicating everything, we're just adding more and more cost on top. That doesn't mean that as an insurance company, we absolve any of our responsibility for a regulatory and consumer perspective, but that's where we need to work closely together. And I think that the risk, if there is one, both to MGAs and to insurance companies, is making sure that we're doing as best we can from a consumer perspective, but also balancing out the need to work together without unnecessary duplication and additional cost, because I think that that isn't good for consumers. And I don't think that that is necessarily what the regulators want us to do. They want to make sure that outcomes are good. So partnering together to do that, I think, is the solution. Those are probably the two main things that I'm seeing today, Tim, from that question.
Great, thank you, Paul. And I've got some questions coming in thick and fast now, so let me read the first of those. Thanks, Paul. You mentioned that insurers should be providing a more bespoke assessment of an MGA's underwriting performance. Whilst the principle feels right, is that bespoke approach always relevant for small to medium-sized MGAs, where the individual MGA's underwriting performance may not be statistically viable? Also, what competencies would you expect an MGA to possess in this area?
Okay, so two parts to that. That's a really thoughtful and good question. Possibly somebody who's got an actuarial background, I suspect. Credibility in numbers. So I think the first thing is the principle is to make sure that, at least from our perspective, that we're reserving and considering each MGA in isolation. So we reserve, as I mentioned, on a class product and MGA level. We don't do it in a broad portfolio of property or motor. How do we do that if we don't have credibility of information? Well, that then tends to be, we do look across a broader portfolio to look to see what those themes are, and we use market data. We do data enrichment as to how that might well help us. And there's various sources that we can do that. I think the challenge tends to come with lack of credibility is within what range is that particular result operating in. I think all too often we focus in on an exact number, thinking all of this is an exact science. A lot of it is assumption driven, particularly when you're talking about IBNR and reserving calculations. So therefore, for us is, are we operating within an acceptable range? And is the activity that's being taken, will that justify a underwriting profitability probability of success? And that's probably tends to be the way that we do it. So that was the first part of the question. Just to remind me, Tim, the second question was?
That's what competencies would you expect an MGA to possess in this area?
Yeah. So I think here, this is quite difficult for some of the members. I think capability is, where do you get actuarial or analytical capability? I think with what we would look for is that MGAs would have at least what I call rudimentary analytical capability to understand and describe their portfolio. Things like, it could be types of products, types of limit profiles, it may be average premiums, average claim sizes per cause, understanding trends, trying to be able to describe the book of business, I think, is where that minimum capability needs to be. Some of that may be in-house, but also some maybe through third-party contractors who provide services. And I am aware that there are a number of organisations that can provide some of these services to MGAs. And also that's where certainly Bridgehaven, as an example, would also be able to provide added value, and other hybrid fronts will do the same, where they should be able to provide insights and information into the portfolio as it matures. This is an ever, if you like, developing area, particularly as we try to merge external data, data enrichment, other insights, benchmarking to see whether the books of business for that particular product, that MGA is, upper quartile, is it bottom quartile, where is it? Because often that's quite difficult for some MGAs to see, well, where am I in the spectrum? Am I doing a great job? Am I doing a good job? Do I need to improve certain things? And that's where the transparency and I think the cooperation with hybrid fronters or any insurer needs to be more at the forefront. It's the partnership arrangement of working together, I think, needs to be a bit more. But I don't necessarily expect all the competencies to be in every MGA, but I certainly would value the analytical capability and being able to describe the portfolio, I think is important.
Thanks, Paul. And the next question, do hybrid fronting insurers benefit from rated financial strength from the likes of Standard & Poor's or AM Best?
Yeah, and I think that's a great question. For us particularly, we are AM Best rated, we're an A- rating. We made that decision because we're focused as an organization more on commercial and specialty space. I think that question, depending on the members, may also look at the product. What do their end customers want? What does the MGA need from its insurance partner? Financial strength, I think, is important. I think there has been certainly our journey with the PRA. One of the things that we talked about was being rated, making sure that that was an important driver for us as a business, and giving our audience, our MGAs, our reinsurance partners, any of our other stakeholders and customers, the recognition that we do have that financial strength. I'm not going to say that everybody must be rated, but I think that that's certainly a key factor that with hybrid fronts coming in, depending on their focus, it depends if they're focused on some of the personal lines areas that may not require a rating or the commercial and specialty space where I would say customers do demand it. Personally, I would suspect that most companies that come into the UK to be regulated in the UK by the PRA, I suspect they'll all be rated, would be my expectation. Maybe it's more common for entities that passport into the UK. Maybe they'll be less rated, which tends to be the case at the moment with Gibraltar as an example.
Great. And the next question, broadly, what gross claims plus commission ratio do capital providers, reinsurers seek from an MGA to deliver their required return and cover expenses?
Now, that's a great question. So, as usual, it depends. And it depends a little bit on product. So, short tail versus long tail. It may also depend on the attrition versus large versus cat loadings. So, unfortunately, I'm going to do the usual sitting on the fence. I'm not going to give you an exact answer. But what I am going to give you is, from our own business model, I mentioned that we're trying to keep our cost base very efficient. We recognize a lot of the work transfer is done by MGA members. So what we don't want to do is duplicate everything that an MGA member does, where we don't want to duplicate the underwriting policy issuance systems. We don't want to do the same with claims administration systems. We don't want to be doing sales directly ourselves. So for us, we have a lower cost of capital. So if I was to use an analogy, and these aren't exact numbers, but as the member asked the question, I'm going to give you this as my thought process. If I'm saying that an insurer A needs to cover its expense base, and its expense base is running at 20%, they need claims and commission ratio to be no more than 80. If I'm saying that for us, we've got our expense base is running at 5 and there's a profit margin of another 5, we can theoretically run it at 90. So our objective is therefore to partner with other reinsurers, other capital providers that are also willing to accept ratios around 90. But what I will say to your members is, whilst everybody's probably writing down, this is great, we're going to get more upfront commission. It's more around the alignment of interest and sharing the upside. I think the point I was trying to make with that 80 to 90 example, there's additional 10 points potentially available. It is dependent on product and various other factors. But what we should be trying to aspire is to share more of the upside with MGA members that are writing good, profitable books. I think profit commissions are possible, but it all depends on the minimum expense loading and profit margin that an insurer wants to keep. Traditionally, you'll hear 15% from the Lloyd's market. You may hear 20% from others. Maybe it'll be lower for other community groups. But as a broad range, this model should have more economic benefit in the long term in sharing more of the, if you like, the profitability across the longer period of time than maybe more of the short term that have a higher expense base and a higher return on capital. Long explanation. I probably didn't answer it particularly well, but hopefully that helps.
Thanks, Paul. And does the reliance on reinsurance increase volatility in stability and pricing compared to a more traditional model? Does the model not add an additional layer of capacity exposure in the chain for the client?
I actually think it's the other way around. I think it reduces it. And the reason I say I think it reduces it is what we want to do is, and we want to recognize the MGA is where, if you like, the USP sits, where the pricing needs to sit. And in our model, it's around what we call trust and verify. It's saying to the MGA, you've got the expertise. We will support you in your expertise, and we will align Bridgehaven and reinsurers that will support you and will delegate authority to you within guidelines, of course, but we support you in the development of what you want to do. That includes pricing models, risk appetite, risk selection, and so on. And what we should be doing is that partnering together to support the development of whether it's pricing models, data enrichment, the other aspirational points that an MGA wants to do. And that's through our model is delegating more, as I use more, it's delegating the authority down with actually less intrusiveness, subject to the underwriting performance fitting within the parameters that we've all agreed at the outset. And then that underwriting performance. So I don't think it's adding in more complexity depending on how the hybrid front delegates authority. So I can't speak for the whole market of how it delegates, but you want to be partnering with those people that trust and will support the models that you have. If you have lots of referral triggers and lots of, if you like, checks and balances of everything you do, then maybe that's why I'm saying it's the alternative way around here, is I think the partnership and the way reinsurers look to support Bridgehaven and MGA partners is actually probably more streamlined.
And then what about collateralization? Are hybrid fronting insurers in a position to require collateral from capital providers? If so, to what extent, and is there any standard?
Also a very good question. As we look at those 4 different buckets of capacity, so I mentioned traditional insurers that are rated. So you might have S&P rating, AM Best rating, and so on. Those we recognize or will look at the jurisdiction, their financial position, their rating, and various other factors, and often we don't look at collateral. When you're looking at unrated vehicles, that could be captives, that could be pension funds that may set up retention vehicles, or ILSs, we will then look at the quality of the collateral that sits against it. And there's different ranking of collateral that we may consider. There's, if you like, cash in a bank account. There are letters of credit that may well come from banking facilities that are against assets that the entity owns. There may be other solutions that may be put forward, such as parental guarantees. I think the one thing I would highlight to the members is where I think the industry has recognized there was a material weakness, and this comes out of the US, it's not been in the UK directly. This was something called Vestu. There was fraud occurred between an entity that was getting letters of credit, and it was a fraudulent approach, and these assets never actually existed. So the protection wasn't in place. So I think What we would be looking to do from a ranking of collateral is looking at the quality of that collateral and validating it. Is it liquid, cash? Is it illiquid? And therefore, where does the asset sit and how do we get access to it? And to be honest, it will depend very much, again, on product, short tail, long tail, scale of the question, also jurisdiction of where the originating entity exists. Is it a recognized jurisdiction? Could be Bermuda, it might be in the Cayman Islands. If it's in a different country that has got very loose regulation, maybe we wouldn't be accepting certain collateral, and maybe wouldn't even want to partner with them. So again, it's one of those questions that's it's a great question, but it just depends on the circumstances. For us, it's ranking of collateral from liquid upwards. The more liquid, cash-based we can get access to, the more comfortable we usually are.
And what are the benefits of the hybrid fronting model to reinsurers?
Yeah, because we didn't touch on reinsurers. Obviously, this for members was focused very much on the hybrid fronting model, what benefits were for MGAA members. So for reinsurers, the reason reinsurers are like the hybrid fronting model is for a few things. One, the partnership with an entity, a hybrid front that takes care of the underwriting result with the MGA members, so underwriting profitability. They want to align with and have transparency around the transaction and what's actually happening. So with the model that I've talked about here, MGA member, Bridgehaven and reinsurance panel, there is full transparency, and reinsurers like that. They also like the ability to access business ground up on a broad range of classes of business. Now, that doesn't mean every reinsurer wants to write every class of business, but it's the access, because over, I don't know, probably the last 5-10 years, reinsurers have been pushed further, what we call down the tail risk. Insurance companies have retained more to the balance sheet. They have catastrophe exposures that they pass on to the reinsurance market. There may be certain products with tail exposure that they don't particularly like, and it may be on some of the liability programs, some of the legacy books of business. So reinsurance capital has often been used in the, if you like, the end of the tail and in a particular area. So to diversify, reinsurers actually like quota share or proportional reinsurance. They like the ability to deal with a broad range of products that MGA members have. They actually quite like the alignment of interest with good quality underwritten portfolios, with us supporting and working with the MGA to take care of that underwriting profitability, and then reinsurers are therefore got confidence to join or to support this model. The counter to that was when I mentioned fronting insurers, I think the opposite is true, because fronting insurers traditionally don't care about the underwriting risk. They just pass that back to the reinsurers or the capacity. I think that that's where reinsurers don't like that situation. But with a hybrid front, as I mentioned, diversification, ground up exposure, the transparency and the partnership, the alignment of interest, certainly the alignment of interest through profit commissions and so on, is very much what attracts reinsurance. But again, depends on the product class and the quality of the underlying business.
And the next question, Paul, are there any regulatory challenges in your business model?
Yeah, so look, any business has its challenges. We're a new startup. So one of our challenges is, working with and identifying the right partners. So we may not be the right partner for every MGA. We have our own thought process around commercial and specialty, particular scale, particular type of balance between short tail and long tail types of portfolios. So for us, it's growing the right type of portfolio. I think regulation continues to be a challenge for all of us. It's not particular to the hybrid front, but it's a focus on ARs, principles in ARs, whether it's the consumer duty regulations, whether it's operational resilience, which is coming out next. There are various other things that will be a challenge to us as a sector, but working together, I think we can overcome those. There's also for us, and I did touch on it a minute ago, which is what are the learnings we can take from other markets? And I did mention the situation where the question around collateral and what quality of collateral. And I mentioned one of the learnings from a company called Vestu where there was fraud occurred, and that had a particular impact that was learnt in the US on hybrid fronters. So I think that is something that from a risk point of view is very much around the counterparty exposure, making sure that we've got the right reinsurance support is really important. But from a regulatory point of view, I also think it's important to reflect that we have a very supportive regulator in the UK. So the PRA, who are a principal regulator from a prudential point of view, from capital, and the FCA from obviously a consumer point of view, we're regulated by both. They are very supportive of our business model, one, because of competition coming into the UK, but also they're supportive of making sure that from a quality of business model, of the professionalism that we bring, of the underwriting performance, the business acumen, I think that that's an important thing to understand, that the regulator is actually supportive, understands delegation of authority, allows us to manage the sort of responsibility and oversight for working with MGA members. They understand MGAs, and I think that that's something that's important to understand, and not all regulators act in the same way. Whilst we get very frustrated sometimes with the bureaucracy that comes with regulators, I am actually going to say we have a very supportive regulator. And of course I'd say that because we were the first hybrid front to be approved in the UK last year.
And the last question, Paul, how do you see the MGA market evolving over the next few years? And how do you see the hybrid fronting market adapting to any changes?
So like everything I was mentioning right at the beginning, I'm constantly learning, so I am. And I'm learning a lot from our MGA members, and I'm also learning a lot with what's going on in the UK and global market. So let's just talk about a couple of quick ones. So at a macro level, we've obviously got a changing landscape on a number of things, whether that be some of the climate change, we've got sector focus, so renewables, an ESG focus, which tends to reflect in on the transition from fossil fuels to renewables. So there will be opportunities that will be very particular, not only to us in the UK, but globally, and it'll be a global impact. I think there's significant social change, there's going to be political change, there's constant change. And I think the insurance sector has been quite good actually adapting to different circumstances and changes, which is where I think MGAs in particular have a unique position. I think they can adapt much quicker, they're more agile, they're more responsive to customer demands. I believe that the MGA or the MGAs will have a growing presence even from where we are today. I don't want to predict what the MGA membership will be like in the future. I'm sure Mike Keating would love to do that. But I see this as double-digit type growth, both in the UK and internationally, particularly Europe and some other territories. So I see a growing segment, changing macroeconomic situation, not necessarily inflationary pressures. I'm just talking more broadly about sector change, political change. But then also I see the opportunity that the hybrid fronts in particular will be a disruptive influence in the UK. So I see that because I was just describing, is it not a good thing that we have more solutions, more opportunities for both MGAs and customers in the UK? Competition surely is good. So I only see more companies coming in, validating the model that we started. I see us providing and attracting more capital over time, more interest more globally from reinsurers, traditional, non-traditional reinsurance communities, wanting to support good quality underwritten portfolios, giving better solutions and alternatives. And ultimately that should also be at a lower cost base, which I mentioned before, which again may well flow into better benefits and costs pricing to our customers. So maybe not going to try to predict, but 5-10 years time, maybe the hybrid fronting is the key model that will support MGAs. Who knows? That could well be a prediction.
Great, thanks, Paul. A great note to end on as well, I think. If we could just flick, Paul, to the contact details slide, that'd be great in case anyone wants to get in contact. Fantastic. Yeah, thanks once again, Paul, for a very interesting session. And you can reach Paul at the contact details shown on screen now, or do feel free to contact me at tim.richards@mgaa.co.uk with any questions or introductions, and I'll be happy to pass these on to Paul. Thanks also to all of you for joining us. Please don't forget to provide your feedback and do look out for forthcoming MGAA events. I do hope you all have a great afternoon. So thanks again for joining us, and thanks again, Paul, and see you all soon.